Hello. What we're looking to do here with this video is just show the overview of our planning software, trying to give an idea as to how we use it in some very basic scenarios. This can be as complex and as detailed as we want, or as simplified as clients might need. To give you an idea, this screen here shows where we input all of the information. So here we've got Mr. and Mrs. example, their ages, they have 2 children. Mr. James is creative, Jess is the higher earner and is a professional. We've got a number of kind of accounts, some savings accounts you can see here with some cash savings and some small ISA savings that they've started with. We have the main residence, but it's not the home that they want for life. We've got the start of their pension savings and the state pensions. There's a few other elements, you will see in here, such as cash sweep and drawdowns, and these are tools that the system uses. We've then got debt. So the main debt is the main residence mortgage. And we've got some life assurance plans associated to work. And then the more interesting and fun stuff are the general living expenses, etc. You can see there's some milestone and luxury expenses here. In this instance, they want their children to go to private school from age 11 onwards. They have some treats that they want to enjoy, specifically at the 25-year anniversary, and I can show you where these feed in. So if we get to the top, and I'll come back to that graph in a second, we have the client's timeline now. And this is nice to see because it's nice and full. We have the start here, but then we have holidays. Every 10 years they want to take holidays. They stated that they want to retire at 65. We've got house deposits for their children, the 25-year anniversary, and then we've planned them funding all through school for their children, starting at age 11 and finishing when they're both 22. So you can see these down here and where they drop in across the rest of the plan. They're highlighted to different owners and who they relate to. So we can see a relatively detailed plan here. And each of these life events have expenses associated to them. What this provides us with is this graph. Now I'm just going to click here, which will show us some detail. But what we can see here in this graph, as you go along year by year, in fact I'll come out of that so I can show you first, is a light blue line which follows along, and then a dark black line. This is the dark black, and then this is the light blue. Now the light blue shows their essential spending, which in this instance is around about £2,000 a month over and above the debt and the savings that they have. The black line shows their ideal expenses, so you can see jumps in different years, like here, where you can see their income need jumps up because they have a house deposit to fund for their children or a large holiday. Now the great thing about this graph is that it shows that everything is blue. Each of these columns is a year in the life of the clients. We can see the year there, 2047, and their age, 64, 63, 64. So each year, 62, 60, 61, etc., drops down in terms of their ages. The blue is the total amount of income that's being generated. So whilst they're working, they're funding their lifestyle, really with quite a lot of excess. There's no real major issues here whatsoever. And then when they stop working, everything is still blue. There's no red in the graph. If we wanted to show you in detail, we can really look at this. We can look at what the total costs are. So that's the red with the black line showing all of the expenditure. And as we build this out, we have employment sorting them out until age 65. State pensions kick in thereafter. And then the rest is mostly money pensions and some savings and investments here. Overall, nice, solid looking position. There's a few other views that we can get in this as well. We can look at the client's assets. So here you can see pensions, investments, savings, and then their property, the non-liquid. These numbers do look huge, but actually when you click into this and we use this tab, which shows real money, it takes inflation into account, you can see, in real life, these clients build wealth over the years, and then because their spending equals it, they stay relatively stable here with £340,000 with pensions and £266,000 with investments. A nice, solid, overall looking financial position. Now that's great. So we've got assets. We can look at the different expenses and how they build and then stop. We can look at their debt, which is paid off over years, and their overall net worth. So there's a range. Taxes, obviously paying much more in employment and less when we're drawing money out because they don't need as much. It gets us back to our cash flow. Now, in terms of planning, this is the starting point. This is where we will show clients where we're at, what they have, and where things look if they make no changes. With these clients, there was a major flaw in what they were doing, and all that was that Jess's pension, she works for a really good firm of accountants. Her pension, she had the option of a 7% matched pension contribution. As things stand, she was only making a 3% matched contribution, and she didn't know whether she should or she shouldn't up that. What we did was we looked at the position with her maximising her pension, and whilst this view looks very similar, what has changed is just that pension contribution. And if I just jumped into that now, I can show the difference here. Looking at Jess's pensions, here she's contributing 7% of her salary, and her company matched that to 100%. The most important thing to consider here is everything's still blue. They're never short of money. When we actually analysed this and looked at it as in where things stood on day one, we could compare one plan to another. So if we compare these plans here, we can see we've got the normal starting position that we've been through, and now with the pensions being maxed. The difference between these two is £240 per month in these clients' pockets. Instead of Jess receiving £240 a month, she makes that contribution to her pension. The company match that. It works out as a lot more of that because of the tax planning. But ultimately, the long-term position is completely different when we look at their assets. If we take the age that they intend to retire, 65, we can see with this change in pension planning, they are up to £1.646 million in pensions, whereas it's only 1.3 when you look down here. And this shows the effect of compound interest, but realistically, it shows the effect of making sure your affairs are accurately in order and efficient early on in the process. We can look at these in terms of real money because it's probably more realistic to look at that. And again, if we look at this now, 452 versus 719,000. It's a huge difference for these clients for a very small reduction in income that they didn't really need over here anyway. To give you an idea, this is just the starting point, but we build them buying a home for life, we look at them retiring early, and we look at them buying the home for life and retiring early and plan all of those things out. Alongside that, we can do a huge amount more. We can maximise investments. We can look at how tax planning would work. We can manage for a future inheritance tax liability. And all of these things develop over time in the plan. Hopefully this gives a flavour of what it is we do here. It is different to many firms and we have a strong focus on this, but we would love to work with anybody trying to build these forecasts and these plans forward. And so feel free to get in touch with us to run through your needs. Thank you very much.